Welcome to It's the Economy. Happy Diwali to all of you, but we are starting on a slightly serious note. In a surprise move on Friday night after the US stock markets closed, rating agency Moody's downgraded its outlook on US Treasuries to a negative from positive. And the reason it cited was no improvement in the fiscal deficit situation and no foreseeable improvement in US debt and deficit. The action did not result in a rating downgrade. Moody still rates the bonds as AAA. It's the outlook that's negative. And as you all know, rating agencies Fitch and S&P already have downgraded US bonds, and they stand at AA plus and not at AAA plus for these two rating agencies. Nevertheless, we have to see how the impact will happen, and we will know that in the trading day today. But to help us parse the impact, I have with me Neeraj Gambhir, the Group Executive and Head, Treasury Markets and Wholesale Banking Products at Axis Bank, and Stephen Englander, the Global Head of G10 FX Research in North America Macro Strategy at Standard Chartered. Steve is joining us, of course, all the way from the United States. Gentlemen, thank you very much for your time. Neeraj, with your permission, I'll speak to Steve first because he stayed up for me and I'm deeply grateful to him for that. Steve, Moody's changing in their outlook on US Treasuries, though it's not a downgrade yet. Now, will the market take it badly when it opens on Monday?
I don't think so. They seem to be a little bit late to the game. And, I think the market has already absorbed the downgrades from the other agencies and kind of understands the fiscal situation, I think, whether or not, Moody's actually goes ahead with the downgrade.
But there is a fiscal issue separately. Every quarter when the Treasury announces its borrowing program, like it did in October, it does impact markets, doesn't it?
Well, we've probably seen most of the impact because I think the expectations are pretty pessimistic. But, if you take a look at the increase in the term premium, it's basically, 50 to 100 basis points. It doesn't have to go to 200 basis points to be damaging. This is damaging enough. And I think it represents a market that's, scared of the fiscal outlook and sees no way out.
Okay. Well, what's your sense, Neeraj? Good morning and thank you for joining us. What's your sense? Do you think it just reminds the market time and again that there is this fiscal issue? Do you expect trouble?
Yeah, good morning, Latha, and happy Diwali to you and all the viewers.
Thank you.
Yes, I think it's once again, the conversations around US fiscal deficit, while it fundamentally doesn't change anything, I think it just reminds the market that this animal is sitting there and we need to worry about this. And clearly the forecast that Moody has put out don't give a very good sense of how and when US will be in a position to control its fiscal deficit. I think they've also flagged off the current difficult political situation that's there in US. And we know that there is a bit of a challenge in terms of extending the shutdown that is looming large. And we have to see how that plays out. And then the question of how the fiscal math will be negotiated between the two parties. All of this remains to be seen. And therefore, this is kind of a bit of a burden on the market at this point in time to see how this funding is going to be managed. I also want to highlight here two things. One is that as US Treasury supply has increased, the holdings by the global central banks has been steadily coming down. So there is one element of that demand which has been steadily coming down, and it is creating a bit of a demand-supply challenge. The second is that you must have seen the survey on the inflation expectations in US, and there has been a bit of an increase there. We have been now seeing a steady increase in the inflation expectations. And this should be a big issue for Fed. I think Fed, therefore, cannot keep the foot off the brake for now, because so far the story has been that while in the short run inflation has gone up, but the long-term expectations have been well anchored. So if the well anchored story takes a bit of a beating, then there is cause to worry.
Okay, well, let me get back to Steve on that point. Steve, what do you think will be the range for the US Treasury yield for now? Does it stay closer to 5?
In the longer term, it obviously depends on how inflation and fiscal play out. We think in the shorter term that the U.S. economy is going to slow down, and once it does slow down, we'll get some relief that the 10-year yield will go, closer to 450, 425, somewhere into that range. It may not stay there, but I think when the market absorbs that there is a genuine slowdown, we will see lower yields.
Okay. What's your sense, Neeraj? Are you penciling in that U.S. yields will fall much, or if we have to, make peace with a closer to 5% U.S. yields for, say, a better part of 2024, what does it mean for a country like India?
So clearly, it's slightly hard to take a definitive view on this because data is evolving and the situation keeps on changing. But my guess is that somewhere between 4.5 or thereabouts, 4.5 to 475 is a good range for the short term. In the longer term, we'll have to see how inflation story settles down, how growth story evolves from here. But yields at these levels of between 4.5 to 5% clearly reduce the premium that India has over US yields. Our domestic bond yield is currently close to 7.5%. So it does make the issue of flows to emerging market countries a bit more challenging. The positive on India's side is that we have this index inclusion flows, which are expected to start from the first quarter of next calendar, and they are likely to actually help, in terms of increasing the demand of these bonds from the international players. So I think if that was not the case, probably we would have seen a far higher impact on the domestic yields than what we have seen so far.
Okay. I'll come back to you specifically for the domestic pressures on the yield. But let me just finish the currency bit. Steve, dollar index at around 105.89 as we speak. Will it strengthen because of the high yields?
Ultimately, we think it's going to weaken, when the yields come off. That may not be for a couple of months. So in the meantime, I think that there is some room. The economic picture in Europe is pretty dismal. The UK is pretty dismal. I don't think the dollar is going to go to the moon, but we could still see a couple of % of gains in the short term before it turns around.
Okay. Neeraj, when I asked you about the rate differential, the US yields and its impact on India, I was expecting you to touch on the currency. What's your sense? I mean, the RBI has threatened an OMO, which doesn't look possible because the market is already deficit on liquidity. What's your reading of the currency? The RBI let it go on Friday. You think a slow depreciation? Any thoughts on the rupee's trajectory?
Yeah, if you look at year to date, rupee has been fairly strong compared to some of the other major emerging market countries. And the fact that US dollar has strengthened of late hasn't really reflected in the way rupee has behaved. It's very well anchored. So some bit of steady depreciation bias in rupee, though I don't expect too much of volatility because it is being well managed, is par for the course in my view. So we should expect a steady depreciation in rupee to continue. Also, given the fact that we have seen a significant outflows from equities in the last 4 or 5 weeks, I think total about 40,000 crores has gone out. That is also putting a bit of a pressure on the currency market. But it is very well behaved. The volatility is quite low. In fact, if you see the volatility in the options market, it has a multi-year low. So steady depreciation bias is my view. I think we should move towards about 83.75 to 84 over the next few months' time as the dollar strength continues to have its play, as Steve mentioned. And we do see there is a bit of a challenge in terms of flows coming to the emerging markets.
Okay. What about an OMO now? Do you think that's ruled out? Because every day we are seeing the rupee in deficit. I mean, the liquidity in deficit. Is that threat over and done with?
I expect the OMOs to be used as and when the system becomes reasonably and sustained surplus in terms of liquidity. And in some senses, if the expectations on portfolio flows on fixed income materialize in the first quarter, that's the time that I think that it'll be more appropriate for Reserve Bank to start using OMOs, because in any case, if they are intervening in the market to basically balance these flows, then sterilization of these flows would be probably done through the open market operations. So that's my expectation. As long as the system liquidity stays tight, I'm not sure if it makes sense to use the OMO as a tool for the time being.
Okay. Let me try and squeeze one more set of questions to both of you. Steve, is there a likelihood of a financial accident? Some economists worry that there will be a reset of rates in 2024 in the US for financial and non-financial entities. Do you think there can be such an accident?
There could be. I mean, it's hard to predict accidents. We all drive and we never expect to get an accident. I think that one thing that you are seeing is that there are pockets of liquidity, say from private equity, from other sources. You may not like what they're offering you, but at least there's a bid on the table for, commercial real estate and other assets like that. That said, I think we're also seeing that, credit is getting tougher. So you don't need an accident. It could be that we're just going to get a traditional slowdown because credit is tight, and that's going to generate, lower yields and a weaker dollar over time.
A quick reaction, Neeraj, do you think we should be prepared for something as yields rise?
Yeah, I think the chances of something going wrong increase as at these kind of rates in US, particularly an economy which hasn't seen such high rates in a very long period of time. But having said that, I must say that the credit markets in US have been very well behaved in this cycle. I think it's pretty surprising to see that why higher yields have not yet translated into tighter credit conditions or any accident on the credit side. But, will something happen? Has the probability increased? In some senses, yes. But you could potentially have a very orderly slowdown in the US economy, which is also seems to be the base case for US Fed.
Okay. Well, we'll have to wait and see on that. Thank you very much, Neeraj and Steve, for your discussion on the US bond markets and its impact. Actually, Neelkan Mishra of Axis, again, believes there can be some bit of an accident in the US. But we'll wait and see. We'll wrap up on Bazaar on that note. There's a bit of red on the screen. Chartbusters will take the action forward.